Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is Monday, October 7th. We are going to look at a subscriber suggestion here, or a viewer suggestion anyway. I think Jeff may be a subscriber. We are going to do one for Jeff Herlick. Congrats on your record September dividends. Thank you. Could you please do a video on Main Street Capital? It's an interesting company. As always, great content. Again, I appreciate that, and thank you for the suggestion. We will take a look at Main Street Capital Corporation. This is actually a business development company, a BDC, and it is out of the financial sector. Now, before we get too far in the video, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the vested interest community. Click that notification bell down below so you're notified whenever we put out any new content. I do these stock pick of the day videos Monday through Thursday whenever the market's open, as well as a portfolio update typically on Sunday mornings. I did just put out the portfolio update for this week because I had a little issue with being able to get the information I needed for Sunday's portfolio update. But make sure you click that notification bell. Drop a comment down below. Let me know what you think of Main Street Capital. Is it in your portfolio? Is it one you're watching? Is it one maybe you're selling? A lot of stocks at record highs right now. A lot of people are taking some profits, I think. Actually, it looks like some people might have been doing that at the end of the market today with a little bit of a downturn in some names out there. And a very special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. Now, this is the vested interest stock screener. We will be running through this criteria and seeing how this one stacks up at the end of the video. Since it is a financial company, we will be looking at 6 of 9 here. We use price to book for banks, business development companies like this, insurance companies. So it will be 6 of 9 for this one here. And we'll run through this criteria at the end the way we always do. Now, you can use this screener. You can modify this screener. This is the screener that I look at companies on a high level to see if I'm interested in adding them to my watch list. Just because it meets 5 of 8 or 6 of 9 for financial companies does not mean I'm investing. It just means it goes onto my watch list. And then I do more of a deep dive into the financials of the company, looking at their balance sheet, their income statement, stuff like their debt to equity ratios. Are they paying down debt? Are their margins growing and expanding? Is their revenue growing and expanding? Like I said, are they paying down debt? Do they have enough assets over liabilities to pay off their liabilities if they had to with some of their assets? That sort of criteria, price to book, price to peg ratios, a lot of other criteria I look at before I ever invest in a stock. This is just the initial screener. Thousands of stocks out there. This helps me go through them pretty quickly and decide which ones I'd like to do more of a deep dive on. Now, back to Main Street Capital. You can check them out at www.mainstcapital.com. That's www.mainstcapital.com. That's their homepage where I pulled this information from. A true financial partner, Main Street Capital, based in Houston, Texas, has helped over 200 private companies grow or transition by providing flexible private equity and debt capital solutions. That's really what they are. They're kind of like a bank for middle of the road companies, and I don't mean that in a negative way. I just mean by valuation. We provide one-stop capital solutions, private debt and private equity capital, again, similar to a bank, to lower middle market companies, and debt capital to middle market companies. Main Street's lower middle market companies generally have annual revenues between 10 million and 150 million. So again, they're kind of in the middle of the road, so to speak, for companies, right? They're not the $1 billion or plus billions of dollar companies. They're 10 million. They're smarter or smaller. Maybe not necessarily a startup because they're already producing 10 to 150 million in revenue, but pretty close to a startup, starting to grow a little bit, but maybe not able to go to some of the larger banks and get the debt that they need or equity that they need. So they'll go to a business development company and work out a plan and get the capital that they need to continue to grow that business. Now, the reason we are taking a look at them, down 0.1% on the day, so not a big drop, but a drop nonetheless. So I figured we'd take a look at them. We are talking about Main Street Capital Corporation, ticker MAIN. They are a business development company out of the financial sector. Closed out the day at $50.97. Looks like they're up slightly in the after hours, at least when I pulled this information. 52-week range as low as $37.70. 52-week high as $52.39. So they are pretty close to their 52-week high. Market cap of $4.43 or 4.438 billion. So that really is a small cap company. A beta of 1.3, so they are more volatile than the overall market. PE ratio $9.51 per share. I don't really look at PE ratios. We're going to take a look at price to book on this one, but that does seem low. Now you'd want to compare that to other business development companies and see how it shakes out. EPS, earnings per share, sitting at $5.36 per share. Earnings date coming up sometime between October 31st through November 4th. Forward dividend is $3.81. They are a quarterly payer, but they also pay out some special dividends as well. We'll see that here in a little bit. Dividend yield is 7.47%. I believe that does account for the special dividend as well. Ex-dividend date is October 8th. That's actually tomorrow. So you would have had to buy them today or before today, or owned the shares today or before today to get the next payout. And the next payout is coming on December 13th, it looks like. One-year target estimate, at least according to Yahoo Finance, where I pulled this information from, $48.80. So they actually see it slightly overvalued compared to their one-year target estimate. I'm not affiliated with Yahoo Finance, just one of the sources I go to for information. Jumping over to the right, we're going to take a look at dividend yield theory. To do that, we look at their 5-year dividend yield average, 6.46%. We compare that to their current, 7.47%, or over here where it says forward annual dividend yield, 7.47%, same number. Since it is higher than their 5-year average, that speaks to potential undervaluation, at least according to dividend yield theory. So this one, according to dividend yield theory, is potentially undervalued. Now, payout ratio under 74, I like a payout ratio under 75%. This payout ratio says 74.63%, but I'll be honest with you, business development companies, I don't really worry about it too much because typically they pay out a higher percentage similar to REITs than a regular company would. So if they were in the 80-90% range, I wouldn't bat an eye about it. This particular type of company. Business development companies tend to reward shareholders with a significant portion of their free cash flow, right? That's part of the reason they pay special dividends as well. We already went over their ex-dividend date and their dividend payout. Jumping down to price to book, you can see their current price to book is 1.72. Typically for financial companies, you want to use 1 as fair value, under 1 undervalued, over 1 overvalued. Since this is overvalued, let's compare it to itself over the past little over a year. You can see here going back in time to June of 2023, 1.49 price to book. That would have been the cheapest point over the last year to buy this, right? A little bit more expensive in September here at 1.51, a little bit more expensive in December of 2023 at 1.55, same thing in March, 1.63. So it's gotten more expensive over time, and it is about as expensive as you could have bought it over the last year, at least according to price to book, comparing it to itself. And it is over 1. So according to just the nature of price to book, 1 being fair value for financial companies, this one potentially looks overvalued. Again, although dividend yield theory says it's potentially undervalued, right? There's conflicting information there. So let's dig a little bit deeper. Going back in time, I like growing free cash flow. It's typically if a company has growing free cash flow, they have growing dividends to match. Going back to 2021 here, you can see negative $515 million, 2022 negative $246 million, so that's an increase. 2023 up to $285 million, so that's growing. So from 2021 to 2023 looks like growth. Now the problem we have is when we get to the trailing 12 months. Now keep in mind we still have a few months left, 1 quarter left in 2024. So depending on where their year ends, some of these numbers are going to be from 2023 still, right? It's about a quarter is still 2023 numbers, and they're back into the negative $66 million. So nice growth through 2023, but then a downturn looks like in 2024. Repayment of debt, they're repaying debt. Doesn't look like they're repurchasing any shares out of the market, but at least they're repaying debt. But when you look at the repayment of debt, nice that they're paying down debt, but are they really? You want to look at this compared to the issuance of debt, because just because they paid down $2 billion of debt, what if they took out $2.5 billion in loans, right? Then they would be $500 million to the positive, not a repayment. Now, jumping over to stockanalysis.com, this is another source that I go to for information. I always recommend more than one source, and the reason I recommend more than one source is sometimes information is outdated, sometimes it's just not accurate. As you can see here, price targets were last updated on August 14th, 2024, so that means this information is a couple months old already. That's why I always recommend more than one source. Now, they do have 5 analysts that have taken a look at this, again, back in August. They say a low estimate of $44, that would be a 13.65% decrease from where it currently sits. Average estimate of $48.40. That's pretty close to what we saw with Yahoo Finance on the previous page. That would be a 5.01% decrease from where it currently sits. If it happened to hit their high of $52, that would be pretty close to their 52-week high, and that would represent a 2.05% increase from where it currently sits. So for the most part, they kind of see it a little overvalued, at least what they had back in August. Jumping into statistics here, you can see I look at return on equity and return on invested capital. I like 10% or better for both of these metrics. Return on equity at 18.71% is over the 10% I look for there. Return on invested capital a little low at 6.28. I would like to see this above 10%. EPS growth, I like 5% or better projected over the next 5 years. They don't have anything listed, so can't go by that. They didn't reveal their revenue growth forecast either. Again, a couple months old, so just don't have the numbers. Jumping into their dividend history, they are says monthly payer. All right, so I misspoke whenever I said earlier they were a quarterly payer. They pay monthly. Payout ratio 65.71%. So they have them a little lower with Yahoo Finance, or stockanalysis.com has them a little lower than Yahoo Finance did at 65.7. Either way, they're under the 75% I look for. And even if they were over it, I am not as concerned with that for business development company, limited partnerships, or REITs. Dividend growth, nice dividend growth on this one, 9.46%, almost double digits. Growth of 3 years, I think they've been growing it more than 3 years actually. Buyback yield is negative though, I don't like that. That means when they are buying back shares, they're not doing it at opportune times, and I like to see shareholder yield be in the positive as well. So I don't like the negative numbers here. Now going back in time, first we'll cover, they pay out February, March. Well, they pay out every month, but I thought they did some special dividend. There you go, there's that must be one of these is a special dividend. When you see that they double up in a month, one of them is a regular dividend, 24. I'm thinking it's just 30 cents, 24. Yeah, maybe it's the 24 cents looks like they're regular, but then they paid a 30-cent special dividend. Same thing again in June. Looks like they had a 24-cent regular one and then a 30-cent special. Same thing in September. 24 cents and some fractions of a penny, and then another 30 cents. So they do pay special dividends from time to time. But you can see here 24 cents, then they raised it up to 24 cents and some fractions of a penny in July of 2024 here. And then you see those special dividends paid out along the way. So they are returning a lot of capital to the shareholder as well. February, March, April, May, June, July, August. Yep, so they're paying out every month. All right, now jumping back into the vested interest stock screener here, you can see understand the business. That's where we started. So check there. Growing free cash flow, no check there. Growing dividend, yes. Dividend payout ratio is under 75%, so check there. Dividend yield theory says it's potentially undervalued, so check there. Now it is not within 15% of a 52-week low, so no check there. Return on invested capital, return on equity. One of them, return on equity, was over 10%. Return on invested capital was not. Earnings per share growth, they didn't have it listed. And price to book was 1.7, so not 1 or lower. So it really only meets 1, 2, 3, 4 out of the 5 I'm looking for. Really like it to pull back within 15% of a 52-week low. So it might be one to throw on the watch list just if you really like this company. Business development company, very high yield on this one. Payout ratio is fine. Might be one to throw on your watch list regardless and wait for it to pull back to within 15% of a 52-week low. Or what price do you have set on it? I mean, what value do you place on Main Street Capital, right? Maybe you like it within 30% of a 52-week low. Maybe you don't care about where it's at currently. Maybe you have a valuation you've already done. So again, tweak this to your liking and for your investing criteria, right? But for me, it would only meet 4 of 9, so it would not go onto my watch list. Well, as always, appreciate you stopping by. Jeff, hopefully you got some value out of that. Appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community and drop a comment down below. Let me know what you think. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So let me know what you think of Main Street Capital. Is it one in your portfolio? If it is in your portfolio, are you buying it now, or are you waiting for more of a pullback? Would love to hear from you in the comment section. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.